This John Lothian News video is sponsored by How have investor trends evolved?
Clarity of the investment process is certainly one thing that's changed pretty dramatically. I would also say that the due diligence process has become very rigorous, both on the investment side and on the operations side. So the cycle has become quite a bit longer. And I would imagine the flows would primarily come into institutional quality managers that can not only keep an infrastructure for investment purposes, but also adhere to the regulatory changes and so much of the reporting requirements that have increased substantially over time. Lastly, I would just say that there's been a big shift towards customization, and fewer and fewer investors want to buy the off-the-shelf flagship product of a manager or even a fund-to-fund.
What is Campbell & Company's approach to the markets?
We really look at the systematic process as being a marriage between practical market experience, so we have economists and people from the world of finance. We also have mathematicians and scientists. So we really take an intuitive investment thesis. We use our math and our science to test the validity of that thesis, and then we use our technology to build a systematic discipline around that.
What is the message you offer to customers of managed futures today?
Managed futures has a role in a constant role in a portfolio because of its diversifying benefits. So its low correlation to both traditional investments as well as other alternatives means that investors should have a constant allocation to managed futures. What we work with investors on is perhaps modulating that exposure in different environments. In terms of the performance of managed futures, I mean, certainly 2008 was the bright light in many investors' portfolios if they did have exposure to managed futures. And since that time, we've been in a risk-on, risk-off environment where there's quite a bit of central bank activity and government intervention driving higher correlations across asset classes. So it's not to say there haven't been trends, there have just been fewer independent factors for managers to take advantage of. While trend following is our core competency, we have different styles of trend following that are differentiated and can take advantage of different types of markets. So it's market-based trend following in sectors, trend following by correlation, and having more adaptive models. In addition, we have non-trend following strategies that don't necessarily rely on trends or don't necessarily rely on price, particularly at an underlying market level. So we're looking at enhanced carry in currencies. We're looking at the term structure in commodities. We have sector-specific strategies in fixed income, and we have short-term mean reversion strategies in a much shorter time horizon, so less than 2 weeks, even just a few days.
You recently launched a managed futures mutual fund. What are your thoughts about 40 Act funds and their potential?
We're excited about the mutual fund structure. I think it's really another access point for investors. So it's not to say that we don't continue to run managed accounts, commingled funds, private offerings, but it does offer daily liquidity and it offers an ease of access for both private and institutional clients. We're not a mutual fund provider. We certainly don't have experience in the structure. So we went to seek a partner that did have experience, and we partnered with Equinox Fund Management. They created a structure where we could trade pursuant to our flagship managed futures programs. We have an iShare for institutional investors. We have a traditional A share, and we also have a P share that is for the broker-dealer kind of wrap account structures. So there's a little bit of something for everyone. And the tickers on that are EBSIX and EBSPX. I certainly see a proliferation of these structures, and I think it will take hold, not only allowing retail investors access, but certainly for pensions or other institutional investors. It's another way to access this strategy class with liquidity and transparencies.
What's next for Campbell & Company?
We are at $3 billion today, so we have enough assets to have an institutional quality infrastructure, but we also have room for growth. We want to stay in the sweet spot, which is where we are right now. Between 3 and 10 billion, we can continue to have a footprint in less liquid markets like commodities, and we can continue to have diversity of time horizons, so shorter term strategies in that few days to a week. So we want to stay within the right size to keep the viability of our current portfolio structure.